Welcome to the big show. It's the Retire Young radio show. If you're a first-time listener, thanks for stopping by. I am your host, Joshua David, and we are happy to have you with us today. Once again on the program, I have my great friend, my tech-savvy friend, Mr. Al Conningson.
Not Mr. Technology. Don't believe him, folks.
How you doing today, Al?
I'm fantastic. How about you?
Hey, I can't do any better than that. It's always great to be back, helping our Retire Young family make better investing decisions. Al, once again, we had another great move in these in the stock market this week. And, we're going to cover some of that stuff. We're also going to get into the different concepts and techniques that the smart money use to create income, or they do and use to generate returns in retirement accounts. We're going to talk about those retirement accounts. We're also going to get into these other asset classes other than the stock market. We'll talk about the stock market, but something that investors can utilize with their stock market investment strategies. But Al, as I might have mentioned, we had another really good week in the market. I mean, we had some good volatility, some moves up, some moves down. We're seeing some tension with China again. I know I mentioned you're tech savvy. Your favorite app, is that part of the problem? That TikTok app?
Yeah, you seem to be on there all the time. This is, you mentioned movements. The market is moving up, is moving down. As long as it's moving, there are some great opportunities as long as people understand how to take advantage of those different directions. But what we're seeing is a market that just is bent on going up. And a lot of that move has been the result of the technology stocks, the big tech stocks. And last week, the big ones, Apple, Amazon, Facebook, and Google all reported earnings, and
pretty good
Facebook,
ones too.
Apple, and Amazon just blew them away.
Yeah.
So we've had, and this tech-driven situation has been with us since probably 2009 when we came out of that last recession. And I think what's happening is that maybe that their businesses just aren't as dependent on these economic situations or conditions as some of the other sectors and industries are. But again, it really doesn't make any difference. We can't predict things. You mentioned China. Yeah, the U.S. and China, that their relationship there goes up and down. We can't predict what's going to happen there. But what really is important then is what's factual, what factually impacts the markets, what factually impacts the prices. And now we're seeing a lot of the people that are coming into these free investment classes are coming in because they just want to have more control over what's going on with their finances. They want to have a voice in what's happening financially to them. And they want to have the confidence in knowing what they have and knowing why they have it, and whether there are other things that might be better. And what are they? What are the choices that people have? For most people, it's either stock, individual stocks, mutual funds, or annuities, and some bonds. But one of the things we talk about in these classes, Josh, is what the pros are doing, what the institutions are doing, which in most cases is the opposite of what their clients are doing.
Yeah, let's call it the smart money.
The smart money, exactly. Sure, and they would utilize the stock market, but they're not putting their money, the big pros, the big firms are not putting their money in mutual funds or annuities.
They're selling
them, and they're more than happy to sell them to you because there is a lot of profit there.
Yeah.
But and unfortunately, I think what's happening nowadays with many advisors, and this is not true of all of them, of course, but for a lot of the advisors out there, there's more emphasis on gathering more assets to have under management instead of managing the assets already under management. And then what happens there is that the clients are put into something that's more like a cruise control, kind of a cookie cutter type of an investment portfolio. Yeah. It's the typical buy and hold strategy where
they call it the risky or the non-risky. What does that mean too?
Correct. Yeah, and that buy and hold strategy really is dependent on people not making many moves. It's putting together a portfolio and just holding on through corrections and crashes, and it's really put together with no regard to existing price or loss or gain. And what's the problem there? Well, let's talk about price for a minute. Why is price important? That the entry and the exit price of any investment or trade is probably the single most important factor. And that determines whether you're going to have a quality trade or a trade that is not a quality trade. And what we're talking about there is an investment that has the greatest potential for profit and the greatest potential to have high probability of achieving that profit with the least amount of risk at any point in time. And that happens at the turn in price of any asset in any market. And that always happens where supply and demand's out of balance. We talk about this every week, how the significance of supply and demand. And it's just a fact that really can't be argued. When there is more demand or more buyers for a particular asset, price is going to go up. When there's more sellers for a particular asset, the price is going to go down. And the key then is to be able to identify where that supply and demand imbalance is going to take place. In other words, where are the big buyers? Where are the big sellers? And then being able to identify on a price chart where that will be. Why I mentioned price is important, considering loss and considering gain is important. Why is loss important? Well, anytime that there is a loss in a portfolio, the return has to be greater than the percent loss just to get back to even, just to break even before any profit can be made. The real problem there is the time that is lost in waiting for that to happen. And unfortunately, for a lot of us, as we get older, there's less of that time available. And then as far as a gain or profit, well, that can be taken away. And again, the same thing. If you have a profit that is evaporated, there, again, it takes time just to get back to maybe where that profit was before. And that's, again, a time issue, but a lot of times it just results in discouragement.
There is. You mentioned earlier about the FANG stocks, the tech stocks. I mean, that's pretty much what's driving this economy. And you look at the charts, I mean, the S&P is close to all-time highs. The Dow is a little bit lower than that, but the NASDAQ is just blown out of the park. So
Right.
what is it? We've been talking about the disconnect of the economy and the market. There's a bit of a disconnect there. The tech is ruling the market,
Sure.
and that's what's driving it. But you were, mentioning the price action. Price doesn't lie, and that's the most important thing. So, all this fundamental information, it's good information, but that gives us opinions, and you want to utilize supply and demand or a price chart to make your decisions, because that cannot lie. So, Al, you talk a lot about supply and demand, and you get into how the smart money, where they're buying at prices where it's at a wholesale and selling at a retail. It's just two different things. And the public typically do things the total opposite, like you were mentioning, of the institutions or the smart money. Al, in this next segment, we got a lot to cover. We have a lot of people that want to hear more about the smart money and how the smart money creates income, because we have we have this pandemic going on, and a lot of people may be struggling right now. So the institutions, they're most likely not. So coming up next, how the smart money is creating income in their accounts. This is Josh and Al with the Retire Young radio show. We will be right back.